Shares of FedEx getting slammed again today as global growth concerns weigh down the stock. It could be just the first shoe to drop. Bob Pisani is at the New York Stock Exchange with more. Hey, Bob.
Hello, Melissa. It was not a good earnings report. It wasn't just the fact that FedEx lowered its fiscal 2019 earnings guidance. It was the economic commentary. That's what got everybody's attention. The company said that while the U.S. economy was still strong, quote, global trade has slowed in recent months and leading indicators point to ongoing deceleration in global trade near term. It doesn't get more obvious than that. This is what the markets have been fearing, and FedEx now confirms. Predictably, transports led the decline today, especially FedEx. You know, it's down 30% for the month. It's a two-year low right now. Talk about oversold, along with UPS, other shippers, expeditors, C.H. Robinson, for example. So nearly 40% of the revenues from the S&P 500 occur outside the United States. That's why we care about these global comments. Many of the companies with the greatest exposure are in the tech space. They include things like Qualcomm, Lam Research, Jabil Circuit, Applied Materials. All these companies get the vast majority of their revenues overseas, not just 40%, the majority. All of them, of course, you saw trading down today, except for Jabil. Fed Chair Jay Powell said something similar in his press conference, acknowledging that while the U.S. economy was strong, but he took note of some troubling cross currents, in his words, in the global economy that was likely one of the factors that caused the Fed to take a more dovish approach to rate hikes. But as we saw, the Fed was not as dovish as the markets wanted him to be. So where do we go from here? A lot of this selling is now technical. For example, the Dow Jones Industrial Average closed at a new low for the year. That's below the March lows, at the same time as the Dow Transports also closed at a new low. This concerns those who follow Dow theory, which looks for one of the Dow indicators to confirm a trend in the other indicator. When both indicators hit new lows, it's considered a negative technical trend. Back to you, Melissa.
All right. Thank you very much, Bob. Our next guest has been cautious of the overall market, says there's two other names that could get hit by the global growth threat. Let's go off the charts with Chris Verrone of Strategas Research Partners. He's at the Plasma. Hey, Chris.
Hey, Melissa. How you doing? But, let's start with really where the weakness was today. This is FedEx, down 12% on the day. But this was not a one-day affair. This is a stock that peaked almost 12 months ago in January, failed to make a new high in June, failed again in September, failed again just a few weeks ago. So this is a series of lower highs that finished itself on the downside. The stock is now down 40% from the highs. Frankly, it's very reminiscent of the 40% decline that we saw in 2015 and 16. I suspect this 150, 155 neighborhood is ultimately where this washes out. We did the most volume here today that we've done in 20 years. So certainly a cathartic moment, we think, in FedEx. So if the selling is close to done there, where is it not done? And a couple stocks we're frankly a little worried about here. This is Amazon. Really has not been able to bounce at all. We now have a trend problem with the 50 underneath the 200. If you take a long-term look at the chart since 2008, the uptrend intersects at about 1,300. The close below 15 was a big level today. We think ultimately 13 is where this one goes. Microsoft, I think, another example of a stock that we're just not is convinced that this is done on the downside. This has been the best stock in the best sector, in the best index. And ultimately, before the corrective phase is over, they get to all the good ones. We think Microsoft, you break 101, you're looking at $90 here. What does it mean for the broader tape? Well, I think the good news is there are some early indications of maybe some tactical washout conditions. But the trouble is, a rally is just back to downward sloping moving averages. 2,700, I think, is a cap on any rally. Look for maybe 2,400, 2,450 to provide some near-term support. But there's still a lot of missing pieces if we're going to put in a good strategic durable bottom. We're just not there yet.
All right, Chris, why don't you come on over? Shelby will bring the chair over. Thank you,
in
Shelby.
2019, are we going to change back to having a say in who's allowed? No.
Vote? No, she runs the show.
She runs the show?
I'm good with her running the
Not
show.
even
Bring
a comment.
it to
Okay.
show. Run.
Think of the head.
Do you still believe in Dow transport theory, in the Dow theory?
You know
I mean,
what's
does that still
interesting
work?
about Dow transportation theory? Actually, if you look at the broader industrial sector, it has a higher R squared with the broader index than just the transport. So the
correlation.
industrials, yes,
for-
the industrials
okay.
have a higher correlation with the S&P 500 than just the transports. I think the correlation is about 0.85. So we've always said if the industrials are working, it's easy to be bullish. When the industrials are not working, things are more challenging. And the industrials not working is nothing new. I mean, this has been a sector that has largely, as we all know, it's been off the playing field all year. So I think ultimately, if we're going to say the leadership conditions are taking shape for a good bottom or a durable advance, we're going to need to get those industrials back on the playing field, and they're not there.
So, Chris, is it possible when I look at year-to-date performance, I know it's all through a different prism, but when you look at Amazon that's still up 30%, 27% year-to-date, and we're talking about this correction being over.
Yeah.
I mean, that to me means there's a little more fat left to be cut with a lot of these favorite large cap tech names.
I'm with you, and I think as we've all seen in this business, they hit the best stuff last, right? And, up until today, the NASDAQ was still positive on the year, right? Amazon, we don't think it's finished on the downside. Microsoft, as we said earlier, it's been the best stock and the best index and the best sector and the best part of the world for years and years and years. I think that those are the type of names that have to get hit harder before we can definitively say this is finished, and we're not there yet.
And just quickly, there's a whole camp out there that says that markets are oversold, they're oversold, so they're due for a bounce into year's end. Does that hold any water?
Well, this is where I think we need to incorporate the trend work. Yeah, we probably are stretched on the downside, but we're rallying, or we could rally into a weak trend, right? So how do you use those rallies? You use them to lighten exposure, to sell strength, to fade move. So I think that 2650, 2700 area where we kind of broke down from a couple weeks ago is going to prove to be very formidable resistance as we move into the first quarter of 2019.
Chris, thank you. Good to see you.
Good
Chris
seeing you.
Verrone, Strategas. Would you
Big fan.
fade rallies at this point?
That's been the right thing to do since October, and Steve's been pretty steadfast in that belief. So, except for a couple of days, every rally has been a selling opportunity. There have been a handful of days where that wasn't the case, but today's a great example of that. So, in my opinion, until you get a VIX with a 30 handle, that's what you got to do.